Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Bill Gross, investor, the bond king. We're here at your house. Thank you so much for having us, Bill. It's great to see you.
It's great to see you. It's a great day. It's 85 degrees and nobody on the course.
Too hot for him, you think?
Yeah, they leave after Easter. They go to Chicago, they go to Seattle, they leave here, but May is a good month.
Bill, let me ask you about the 10-year Treasury, which is at 4.5% now. Hasn't been this high since 2007. That's a long time. What does 4.5% on the 10-year tell us about where we are, how we got here, and where we're going?
Well, it tells us that inflation has gone up. You know, back in the day, 2 or 3 years ago, it was 1%. Now we're at 4.5%, and so inflation has risen, and it's reflecting the future of inflation. And to my way of thinking, you know, there's this debate about 4% or 5%. I'm in the 5% camp, but it's basically a similar debate about inflation. Will it be 2 or will it be 3? You know, I think it's fairly evident that real interest rates will be higher than they were back in the day. They couldn't get much lower. So we're really talking about an inflation forecast of 2%, which is what the Fed wants, 3%, which is what you know, many in the marketplace, including myself, think is going to happen.
Why is that? Why is inflation persistent? Why is it higher? Why is it maybe higher longer?
Well, the government spends a lot of money. You know, we have annual deficits of $1.5 to $2 trillion, which is 5 to 6% of GDP, which is close to historic ranges for a good period of time of economic growth. And so, you know, it's the government spending, it's the fiscal spending coming out of COVID. It's the economy that's doing much better than people think at 3 to 4% in the last 12 to 18 months.
What kind of job do you think Jay Powell has done? How do you rate him?
I don't rate him highly, and maybe this goes back to the early part of this century in which the Fed didn't know much in terms of derivatives and in terms of you know, credit default swaps and so on. I have a sense that the Fed itself, and you talked about Jay Powell, but I have a sense that the Fed itself is not as oriented towards economics as opposed to social types of considerations. And so I'm a little suspicious of their judgment going forward. Powell in the last 12 to 18 months has, you know, put his foot in the mouth to some extent on some of his forecasts. Doing sort of good now. We'll see, but I trust the market more than Jay Powell. The market, I believe, trusts Jay Powell too much.
I'm going to ask you, are there any Fed chairs that you think did a good job? A lot of people like to criticize Fed chairs. I feel like, is there anyone you hold up and said, no, that person did a good job?
Yes, it's Paul Volcker. You know, he
right.
shut it down. He shut down close to 20% inflation with very high interest rates, and it was painful and hard to do as a Fed chairman. But, you know, he's the mensch, he's the man. And that's a long time ago. You know, since then, there's been other chairman, Bernanke and
Greenspan.
So on. Greenspan, oh, of course, with Greenspan. But I think Volcker's the historical mensch.
The historical mensch. You have been writing your whole career. We'll talk more about that. But most recently, you've written about the fallibility of this notion of total return funds and total returns for bonds, which is something, a concept and a phrase that you popularized yourself. What does it mean that total returns for bonds no longer works?
Well, total return and the Pimco Total Return Fund was the first that basically used that term. You know, it suggested that bonds earn interest, yes, and they have a yield, yes, 4.5%, but they also have the potential for price gains if appropriately priced. And back in the day, back in the early 80s when the concept was basically invented, interest rates on a 10-year were at 15%. And so it was a pretty favorable environment for treasuries to appreciate in price, go down in yield. And so the total return concept, took a 15% 10-year note and combined it with price appreciation of 3 to 4 to 5% a year over that period of time. And you produced a total return, not of 15%, but of 20%. And that was the point where, people thought that bonds could do as well as stocks, and they did for a long period of time. Now, we're at a point in time of 4.5% 10 years, and the debate is whether or not we can resume a bull market, produce price increases, and produce a total return greater than 4.5%. I think that's debatable. I don't think that's going to happen, and I think investors, have to look forward to a 4.5% return at best, and that the total return is something that depends on price appreciation, lower yields, and so therefore we're not going to see it.
The next leg of your criticism beyond that, I think, was that the total return funds have now become essentially index funds.
Yes.
And they're not delivering alpha. You famously delivered alpha in addition to just the index return. And I'm curious, Bill, what your specific strategies were to deliver that extra return.
Well, the main thing was to have a duration longer than the index. It didn't take much, but half a year longer, 1 year longer in terms of duration would produce, some decent total return price appreciation in the Pimco total return. These days, as I observe, I haven't talked to Pimco, I haven't talked to BlackRock, haven't talked to a lot of them, but they seem to be very closely following an index, and the Vanguard index, ETF or index fund, over the last 5 years has only produced a total return of 0.15%.
Cumulatively.
Cumulative.
Not annually,
Yes,
cumulatively.
cumulative. So an
Right.
investor in bonds for the last 5 years, if you followed that index type of approach, would come out with certainly a negative return relative to inflation. And so I simply think that most managers have fallen in love with being a little longer than the index, being a little shorter than the index. If they can just produce an alpha of 50 basis points, perhaps they'll keep their client base. Back in the day with the Pimco Total Return Fund, we were willing to take a little more than that because we had a view. We had a view on the secular forecast in terms of interest rates that they would be going lower. And so, it was relatively constant in terms of a half a year, 1 year longer than the index itself, and that was enough.
Yeah, what do they say? You can't eat relative returns for lunch if it's relative to a negative number, for instance, or something like that. You need an absolute return.
Exactly.
I know you still follow the markets. Can you tell us what you're investing in these days, or what you're following in, what you're interested in?
Well, I've got a few clients. I've got a large foundation, which is $500 million, which is, I guess, my largest client. And then there's my own money and my kids' trust money. And so there's a lot of money working. What I've decided to do, since I don't like bonds.
The bond king doesn't like bonds, right? Okay.
Not at the moment.
Okay.
But to find bond equivalents where the return is relatively steady, the risk is relatively low, the tax benefits are very high. And so that's been in master limited partnership pipelines. There's only 6 or 7 of these things left.
Oil and gas pipelines.
Yes.
Uh-huh.
But they're partnerships. And the reason they're so attractive is that, first of all, their dividends by law are deferred until sold. And second of all, mutual funds, for the most part, can't buy a partnership. And so you have this huge base of potential buyers that have been cut out of the market because of regulatory law, and so attractive, 8 to 9% tax deferred yields. They've gone up by 25 to 30 to 35% in the last 12 to 18 months. It's been a wonderful. It's been almost as good as AI.
NVIDIA, watch out. So, and there's still upside at this point, you think, for these things?
Well,
At least the yield?
I think they've sort of peaked out in terms of price appreciation, but the yields, assuming that there aren't any disasters in terms of energy and pipeline regulatory measures going forward, an 8% tax deferred yield, if you blend in the tax deferral, which I do, it's really a 10 or 11% equivalent yield to basically anything else. So I like them.
What are some of those names? Can you share those with us?
Energy Transfer is the biggest in the business. It yields about 7.9% now. Western Pipeline, my favorite, has just raised its dividend by 30 to 40% in the last 2 or 3 months. The market really doesn't have a sense of that, I don't think, but it yields 9.9%. Tax deferred, prospects are good. I don't know how I know how you go wrong, but I don't think you go wrong.
Awesome. So any other equities, though, or anything else that you want to talk about?
I've taken a dabble in some of the conservative AIs. I own Microsoft. I own IBM. Never NVIDIA. Just too upside downside for me. But those have been the primary ones. There's an interesting play now in terms of utility stocks. They've done very well. And it's not necessarily because interest rates have gone down a little. It's because of the tremendous demand for power from AI generated, types of companies. And so, you see stocks like Edison, Con Edison, and others, Dominion and so on, that, despite their low yields of 4% or so, they have gone up by 10 or 15%. And so, there's a little bubble potential there, but I think utility stocks, believe it or not, have the potential to go higher.
You just had a big birthday. Happy birthday to you.
Well, thank you.
And
I'm 80 now.
80 years old. Yeah. And you have a new book, which is a compendium, really. It's called The King and I, 46 Years of Investment Outlooks, Musing, and Commonsensical Thoughts from Bond King Bill Gross. Do I have that right?
You do have that right.
Okay. What's The King and I? Who else is here?
Well, that's a Yul Brynner type
Yes.
of thing, I guess, and it came from my publicist. But it's meant to basically say there was a public king, and then there was there was me. Nowhere close to what the public image was. To my way of thinking, and my wife Amy, very bashful guy.
So the writings in this book, it's a digital book.
Yes.
And you can buy it.
$9.95.
All right, there you are. A bargain. How many pieces is it? It's from 1978, from your earliest days at Pimco, the company you helped found.
Right, there are 40 years worth of investment outlooks. And, back in the day, nobody wanted to, at Pimco, nobody wanted to write a monthly outlook. I thought it was important to connect with clients. And so I started writing outlooks, but I didn't want to make them dry and boring. And so I introduced, the first page or the second page in terms of introspective ideas about myself, about it, human nature, etc. And there's 40 years worth of these. And I guess it's in addition to the forecast, which obviously produced, incredible results going forward. I think the first or second pages of many of these investment outlooks are what are important to me and what I want my kids to know about me and to read. They've read some of them, but I doubt they've read all 40 years worth. So
You're known to be frank, contrarian, outspoken, even
mm.
sometimes. I wonder if you have any regrets about some of those things you've written, or and then also, what are the highlights? What are the things you're most proud of? I guess it's the pluses and minuses question.
There is one regret. We managed a fund for the National League Umpires Association.
Baseball umpires.
Yes, and I came out with an intro about Norm McSherry, who was a overweight umpire and who died of a heart attack within the first, I think, few innings of opening day. And so I criticized his fatness, so to speak, and we lost the account. So I regret that, I guess, but it was very funny, and I still would recommend that to potential readers going forward.
What are you most proud of?
Most proud, some personal things. One, there was really a poem about Out of Africa, one of the famous movies of 30 or 40 years ago with Meryl Streep, and one about basically my home and what's called Butler Creek, where I grew up in Ohio. So those personal ones are my most favorite, and I think they generated the most reaction from the public themselves.
Right. You have all these other interests, and their background's pretty remarkable. You served in Vietnam. You played blackjack.
Yes.
Do you still play blackjack?
No, it's too boring, and takes I like the action on the crap table, although the crap table, the odds are a little against the roller. But on a blackjack table, if you're counting cards properly, they're a little in the favor of the player. And so, you would wonder why I don't play blackjack. It takes too long. And the people at the table usually are disgusted and angry because they're losing money, and they throw their cards at the table. And so I like the crap table better, where you can yell and scream, and 7-Eleven.
And what about, I'm curious why you got so interested in stamp collecting. You became one of the biggest stamp collectors
Ever.
Right, ever. Stamps.
Very proud of that for 20 years. My mother collected commemorative stamps, 3-cent stamps, back in the day to send me to college, and she gave me a box when I was 17, said, "Bill, take these to San Francisco and sell them." I tried. They wouldn't offer me anything other than 3 cents on the dollar, and so I said, well, she had a good idea, but maybe she bought the wrong stamps. And so I applied the outwork of bond investing to stamps in terms of the provenance, inflation, GDP growth. What are they worth now versus what are they worth 50 years ago? And it seemed to have worked out pretty well. I became perhaps the largest philatelist in a long, long time.
I know you moved to San Francisco, the Bay Area, when you were young with your family, but how did you end up in Southern California?
Well, I ended up in the Navy. That was San Diego, and coming out of San Diego, I had to get a job, I had to get an education. Applied to Anderson at UCLA, and so it sort of kept me in Southern California. Missed Northern California, still root for the 49ers, but I've been a Southern California guy for a long time.
And final question, Bill, how optimistic are you about the United States and the human species, even writ large?
Well, the human species will endure. We will move on, and to doubt human nature is to take the wrong side. Human nature, in terms of optimism, usually carries the day, but we have our problems, as we know, in terms of global warming, globally, in terms of conflicts, demographics in terms of aging. People, the boomers are getting much older now, and they spend less as opposed to more. And so all of these things have risk elements to them in terms of the forward pricing of markets. You asked about human nature. I think there will always be people, there will always be societies that want to do well, want to do better, and will do. And so it doesn't pay to bet against the market, so to speak, or to bet against people.
Bill Gross, thank you so much for your time.
Thank you,
And thank
Andy.
you for having us here.
Oh, great to be here.
This is At Barrons. I'm Andy Serwer. We'll catch you next time.